In Buffett's letter this year, he had mentioned that basically 12 ideas or 12 investments that he made for Berkshire over 58 years were responsible for most of the outcome. These 12 decisions, one of them might have been hiring Ajit Jain, the Coke investment and Amex and Cap Cities and so on, and Seascandy and so on. So one of the questions that comes up is, I think over 58 years, my estimate is that Buffett probably made at least three or 400 important decisions and investing decisions. And the hit rate, if you will, was basically like 4%, 3 or 4%. And it's a 3 or 4% hit rate for Warren Buffett, which doesn't leave a lot of hope for the rest of us mere mortals. And so the question comes up is, why would it take even someone like Warren Buffett to find one good idea approximately every 5 years? And I thought about that, and I think that the 5 year period might actually be almost like a law of investing, law of value investing. And the reason is that for us to get to a conviction level on a particular investment or idea that's going to move the needle means that we have a differentiated view from most of the market. Because if our view was similar to the market, then that would be reflected in the market, and there wouldn't be supernormal results possible. So it's a kind of a, let's say, a differentiated view that causes the outsized returns. And I think the differentiated views, they fall into two categories. They fall into categories where we were delusional, which means that we thought that we had a differentiated view, but in reality we were wrong. So we make the investment, thinking, oh yeah, I've figured out something the market hasn't, etc., and this is going to be great, and it doesn't work. So those don't count in his 12 decisions in 58 years, but he may have had probably one or two dozen of those types of situations where he had very strong conviction, which ended up not being accurate. And the second is that you're actually right on the money, where you got a differentiated view, caused outsized returns. And I think one of the things that Charlie Munger used to say was that if they had not been learning machines over that 58-year period, then their record would be a shadow of what it actually was. In fact, nobody would even talk about them. So basically, the knowledge base and information and understanding about the way the world works that they started out with 58 years ago was relatively small and simple versus what they figured out over the years. So to give you an example, Warren made an investment in Burlington Northern Railway. And first he made an investment in the stock where he bought, some portion of the company. And then I think maybe a few years after that, he made an offer to buy the whole company. And they mentioned a few times that they were always negative on railroads. For most of their career, they said that railroads were actually a poor investment. They were very regulated, unionized, and a lot of inefficiencies. But what happened is that they noticed a few things which caused them to change their mind. So one of the things that happened is the railroads over time basically redid the bridges. They had thousands of bridges. They redid the bridges one by one. So it allowed double stack cars to go underneath them. So instead of having single stack, you could do double stack. And the second is that, with diesel costs and all of that, and the railroads also started becoming more efficient in terms of how they were running, the level of employment, the length of the trains, and so on. So basically a tipping point came where it became much better alternative to the best alternative, which would have been trucks. And trucks, of course, we're a lot of labor and stuff. They can go anywhere and they can go short distances. But anytime you had to go long distances, then the railroads had an advantage. Both Warren and Charlie said that they were actually late to the party. The guy who runs Bill Gates' money at Cascade Investments actually figured it out a few years before them. And I think even Bill Ackman may have figured it out a few years before them. So the thing is that to go through this learning about railroads, for example, where you have a view and then you go through a change in that view, that doesn't happen overnight. That takes a lot of drill down to get to a conviction level and such. So when you look at a 5-year time frame, it could have easily taken them 2 or 3 months or more to really get their arms around railroads. So first they would have had to made a decision that there is meat on this bone, so it's worth studying. And it's worth looking at maybe destroying one of our best loved ideas, which is railroads are stupid. And then you go into the rabbit hole of railroads, which might be 2, 3, 4 months or something. And there's also a lot of rabbit holes you go down, which end up being dry wells, which is you go down the rabbit hole and there is no meat on the bone. And there is no differentiated view, but the time is gone. So basically, if you think about these 3-month type deep dives, in a 5-year period, you can do 20 of them if you had something to do every 3 months. And, maybe 1 out of 3 that you think is great actually turns out to be great. So if you actually did 20, you might have 3 or 4 that look interesting. And then 1 is actually a good idea. If we look at their investment in See's Candy. So See's Candy was a major eye-opener for Warren and Charlie, because the only thing Warren did in terms of interfering with management every year was that on January 1st, he changed the prices of all the candy himself. So he would sit down with the See's Candy price list and he would look at the inflation rate and he would increase it at 2 times the inflation. And what they noticed year after year was that there was no push. They'd increase the prices 15% and volumes were fine. Then they increase it another 10% or 15% the next year and volumes are still fine. And it was a huge learning for them. I mean, there was a huge step function learning for them they were actually in shock that there was no drop in volumes. And actually, if you think about it, so if See's is mostly a California story, right? It's really mostly in California. And in this period from, the 1970s till maybe, let's say 1990, let's say 1970 to 1990, that 20-year period. In that 20-year period, California GDP probably grew at a higher rate than US GDP because it was going through so much growth. Maybe it grew at 4% a year or something. So the See's volume over that period, and I'm extrapolating based on, data that Berkshire's given about, how many pounds are sold and all that. Basically, See's volume from the time they acquired till now has gone up less than 2% a year. In that period from 70 to 90, it probably went up around 2%, like half of California GDP growth. Part of that might have been pushback against these huge price increases Warren was shoving down people's throats along with the candy. Okay. But he saw that, hey, I'm pushing this down and it's not declining. And maybe he knew that, maybe it would have been 4 or 5% growth if I didn't push the volume, if I didn't push the pricing up, but probably in that math equation, it worked better to have higher volumes. So that learning with this, annual tweaking of See's price list eventually led to the investment in Coke. And I'm pretty sure their investment in Coke was at least 6 months in the rabbit hole because, Munger wrote that essay, which is about how Coke becomes 2 trillion eventually and all of that. But basically, the Coke investment actually took about 2 decades to figure out. So they wouldn't have been able to make the Coke investment in 75 or 80 or 85. It was really in the late 80s when they had enough time screwing around with See's that they actually got a big education on brands. And so Buffett never understood brands at all. And suddenly there was this whole new area of this intangible moat, etc., which was tremendous, And so then he was able to leverage that into other consumer packaged goods. And even now the Apple investment is a brand investment. And so the Apple investment actually is 40 years in the making, 40 or 50 years in the making. So I just wanted to share that it is very much worth going down the rabbit holes because the payoffs are so big. It's also very much okay if we hit a lot of dry wells. That's perfectly fine. You only need to get rich once. And one of these rabbit holes could be a mother lode. And so you don't need a lot of differentiated views on a lot of things. So even I would say that Buffett and Munger coming up with this 1 dozen differentiated things. I mean, like insurance is a terrible business. It was a terrible business for Berkshire for 20 years, from the mid 60s till the mid 80s, till Ajit Jain showed up. And when Ajit leaves the scene, that business will shrink for them. There is no successor for that business. So they had an anomaly in Ajit Jain showing up. And they had the second anomaly in Geico showing up, which is more brand insurance. And so basically, even that was a situation which took a long time to basically figure out and kind of know what you can do and what's going on and so on. And it worked out. So basically, I think that's really what I wanted to share, is that basically what we are looking for is we're looking for anomalies. And the anomalies are not just, sitting there ready to be given to us on a platter. We have to go into different rabbit holes. We have to decide which rabbit holes may hold some promise, because there's 50,000 rabbit holes to go down. And if each one took, 3 months, that's 200,000 quarters, which you don't have. So you've got like maybe 100 rabbit holes, or maybe 150 rabbit holes if you're lucky, and got to make them count. So you don't need to make all of them count, but you need to make some of them count. So those were some thoughts I wanted to share with you about why even Buffett and Munger only had 12 hits in 58 years.